Yes, you are listening to the Ready, Set, Retire radio podcast with Steve Anzoni. My name is Jessica Forkel. Get more details on the website at fairwayfinancial.net. For weeks, we've been talking about the Fed and interest rates and inflation and everything is doom and gloom and how are we going to survive? Well, I got news for you. There are ways to capitalize both, before retirement and during retirement on these high interest rates. And Steve, I heard this statement the other day. I want to run it past you. They said,
okay,
when interest rates are low, we refi our house, right?
Absolutely.
Common sense. Exactly. And now when interest rates are high, they say it's time to refinance our retirement. What are they talking about?
What's 100% accurate. And so obviously when it comes to interest rates being low, the great opportunity to refinance a mortgage, if you have one, certainly get it down from 6.5, 7 to 2.25, right? That saves like hundreds of thousands of dollars off your mortgage. Not thousands, hundreds of thousands, okay? So compound interest is an amazing thing, and it can work for you or against you. And the challenge today with people trying to buy homes are, number one, home prices are ridiculously off the map. And unfortunately, I don't see it going the other way anytime soon. Inventory is low, and there's just not enough housing going on. So they're going to stay up there. But the other challenge is that interest rates are high right now. So to buy a home and to get it at 7%, it's costing you a lot more than even if that home was the same price 4 years ago, you'd be paying $1,500 a month less on a mortgage. Crazy. Same house. Well, the other part of that question is when interest rates are high like they are today, you want to refinance your retirement plan. You want to be able to take advantage of the higher rates today. I mean, it's that simple. So if you've got safe money in the bank, let's say, and you've left it in a money market or a savings account and it's still meandering along at 1 or 2%, you're losing a lot of money. And by the way, your banker is not going to call you. They're kind of like your cable company. When there's a deal going on with the cable company, they're not reaching out to their existing customers. You're already their customer. You have to be proactive and call them and say, hey, what's up with this deal? I want to get a better deal on my cable. Well, in this case, I want to get a better deal on my money in your bank, pal. I want 4.25 minimum on a money market account, which is basically a hyped up savings account with 100% liquidity. Or I want to get a CD at 6 months or 8 months, whatever, at 5.25. And they're out there. But you have to be proactive. It's that simple. People have been coming to my office a lot the last few weeks, and I've been looking at their bank accounts and go, what are you doing? And then what are you talking about? Your bank's yielding 1. That's awful. I go, you have to call them. And if they don't give you the right answer, leave. You got to be willing to leave and go somewhere else if they don't want to do the right thing for you. So hope you all are sitting down, or if you're driving, just pay attention and listen for now. You can go online later. I mean, certainly I don't want you calling if you're driving, all right? But what is going on right now in my world, right, is like you just said earlier about refinancing retirement. And there are companies out there right now, because they're getting higher yields on their bond portfolios, and they're usually buying them for 10, 15 years at a time, sometimes 30 years, okay? These companies are getting, 6.25 yield now on these long-term bonds. So they're able to refinance if you have older annuities. Now, when I say older, I'm talking 2 years. Now, I know what you're saying out there. Yeah, but Steve, I have a surrender charge. I know. Okay, I get it. Jess, these companies are not only willing to pay the surrender charge to get your business, they're going to give you 3, 4, 5, 6% more than what the surrender charge is. Okay, depending on the product you're in, the terms, and all that stuff. That part varies, so I can't be exact on the radio. But I'm here to tell you that 90% of my existing customers who've been with me for 2 years or longer are eligible to benefit from it. Okay? Not 100%, but close to 90. I've run all the numbers, okay, until I had a headache. Because, as you know, listeners, I'm the biggest skeptic of my industry. Okay, there is no one bigger than me out there. And I verify. And I ask these companies 5 times, are you sure you're willing to do this? Are you sure you're going to do this? Because, believe it or not, less than 5 months ago, Jess, they weren't willing to do it. This is how crazy it's become. And if you're a consumer, you couldn't ask for a better financial situation. It's like sharks in the water. It's like watching Shark Tank and watching these companies compete for your business. I'm just going to give you 2 examples, okay?
Sure.
No names, 2 examples.
Okay.
So, like customer A, their account is worth roughly $900,000. Their surrender value, that's the value if they cashed it out today, was like $800,900, something like that. By moving it, their new account is worth $1 million.
Whoa.
Okay, $100,000 more. And their interest rate went from 2.25% to 4%. And the only reason why it's not higher is because they advanced such a huge bonus. And their S&P 500 cap rate, which I'll explain more in English if you want to learn more, okay, but trust me, you're going to want to learn more, went from 4.25% to 7.25%. So in other words, the opportunity to earn more is about 3% higher, and they're starting out with a higher rate. It was a no-brainer slam dunk for this person. Now, person 2, I never met before. They happened to call in, I think on the radio or something like that. They had an existing annuity with a very, very highly rated company who I do a lot of work with. It's 6 years old, and the account value, I'm just going to use round numbers, was roughly $690,000.
Mm-hmm.
The surrender value, which means if they surrendered and gave it up, was worth $665,000 and change. All right? Now, the current company was proposing that if they converted it to an income check, which is exactly why this person bought it, which is a great reason to buy an annuity, by the way, they would have got a check for life of $46,000 and change. Okay?
Okay.
So that is roughly 6.5% of the pile.
Mm-hmm.
So get this. You ready for this? So I took the surrender amount. So I took $30,000 less than what the account value was if they stayed with this company. I searched it out there with companies, and I said, hey, anyone out there willing to take this and pay a higher rate? 3 companies came back to me with higher rates.
Wow.
And the highest rate was like almost $52,000. So this guy who's 66 is going to get $6,000 a year more guaranteed for life. So to put that in a percentage pile, okay, roughly 11% more than staying with his company and paying, quote unquote, no surrender charge. Okay, he's getting 11% more. Who in their right mind would not do that?
Yeah, it's common sense. Right?
But it doesn't sound it. It sounds nuts. And by the way, the companies I use are all A-rated or better. Okay? Now listen, there are some okay B-plus rated companies. I do not use them. I used them once years ago. I didn't want to do it. The customer wanted it. And like a fool, I said, fine. And you can't lose money in these annuities, whether it's a B-rated company or whatever, right? There's just no one in the history of mankind has lost a nickel in a fixed annuity. That is a fact, and you can look it up all you want. Now, these companies have failed, but what happens in our industry is other companies come in, they take them over, they make the client whole. But the problem is you could be waiting for months and months and maybe a year before you get your money. Now, that's the last thing you want to do when you're retired. So I will only work with A-rated or better companies. That's why, Jess, okay? These B companies pay a little bit more, but I'm sorry. The added peace of mind with a better company to me is worth more, and to my customers it's worth more.
So, Steve, you just covered a lot of information here. Bottom line, though, is we can take advantage of these higher interest rates. Again, interest rates are low, we refi the house. Interest rates are high, let's refi our retirement. There's other options out there that are available that you could take advantage of. A good time to do a little check-in to see if everything within your portfolio is still working to your advantage or if there's better options out there. So, Steve, for those listening that say, all right, Steve, I'll refi my retirement. What do you have in store for me? How can they sit down with you one-on-one?
This is the best part, all right? A lot of this stuff that I'm talking about can be done online. This person that I never met, it's an online process. And by the way, if it's an IRA, rolling it over, there's no taxes to do it. You can leave where you are now, go to the new company, pay no taxes on that. And of course, when you get the income, you have to report that for income because it's an IRA. That's the deal. But, for those of you, in the Plymouth, Cape Cod area, you could just simply give us a call at 508-552-3230. Okay, 508-552-3230. I'm thinking about refinancing some of my retirement. How does that work? I'd like to meet with Steve. That's how easy it is. The other way is to go online at fairwayfinancial.net. And you can go online there and you can see my schedule and you can either make an in-person meeting down here in our Hyannis office, our flagship office here on Main Street. Or if you live in the Plymouth area, we can do something up in Plymouth as well. Listen, I know I say this all the time on my show. Don't procrastinate. Don't procrastinate. Mm-hmm. And I'm just telling you people right now, I know how these companies work. They have a limited source of funds that this is going to apply to. And I'm telling you right now, this will not last past this summer. It might even not last past July. I've been in business over 35 years, so I'm speaking from experience. And when I say that these companies, limited, I'm talking they may have $500 million to $1 billion earmarked for this project. Now, I know that sounds like a lot of money to us regular folks out there, but to these insurance companies, that might last a month or two in this environment, okay? Because there's all kinds of advisors out there who are all of a sudden going to become annuity experts, okay, who never even did these before, who want to get involved with this, and you're gonna be, it's going to be unbelievable. Even investment houses now are starting to preach the value of these products, and of course, I've been doing this steadfast for over 35 years. Don't wait, okay? Even if you. Like this guy who called me, I said, look, there's probably very small odds that I can improve your position because there's a surrender charge and everything else. Mm-hmm. Boy, was I wrong. And I love being wrong. Just so you know out there, I love to be wrong sometimes, okay, because I am a skeptic. But in this case, I was able to help this guy by 11%. I might be able to help you too, okay? I don't know the answer. And you don't know the answer until you either pick up the phone.
That's right.
Or you go online. I don't know what else to tell you. I can't jump through the mic.
I just want to keep going on this topic here, Steve. It's so important.
It's
huge.
It's so off the shelf. And now let me just be clear, all right? I am not in the business to replace everything out there. That's not my purpose, okay? It just doesn't how I operate. However, when it's in the best interest of the customer and can be clearly shown on paper that it makes sense for them to do it, I'm going to go at it 110%, and I'm going to try to reach everybody out there and at least make them aware of this opportunity. Now, look, you can tell me no, whatever. I don't care. I just want to do my job, and you need to know out there, JQ Public, you need to know what is going on because I'm telling you right now, a lot of your current advisors won't tell you this, okay? They won't even bring it to your attention. That other phone call I got, the current advisor never told this client about this opportunity. And he said to me, he's going with me because I showed it to him. And I said to this guy, I says, look, your existing guy is going to say, oh, I can do this too. Mm-hmm. And he goes, Steve, he didn't. You did, and I'm going to work with you. So that's a shout out to him for doing that, okay, first of all. But this is what's going on, and I'm telling you, you have to be the best advocate for yourself that you can be. Don't rely on anyone else to secure your retirement. Because if you do, you're just leaving everything to chance, okay,
Right.
into other people's hands. I'm telling you, you need to pay attention to this, and you need to do this, or at least get a phone call and find out what the heck is going on. And oh, by the way, if you don't have any of these products yet, you're in even better luck, because the interest rates are so high, you can start out day one making these high rates and getting that money up front on all of it and not just a piece of it.
Well, let me ask you
Jen.
this. I know a lot of folks listening right now are, the radar's gone up. I've seen the phone lines here lighten up. A lot of folks want information about this. One of the questions is, all right, where's the fine print? What's the catch? Do I have to have a certain amount of money to do this, Steve? Is it eligible for everybody? Talk to me about that.
I mean, just about everybody is eligible. I'm not going to say it's eligible for everybody, because it just has to be a good fit. You have to be looking for, you got to be looking for lifetime income. Basically, that's kind of like the number one fit for that type of product. So there's really two versions. So one version is lifetime income check. And with that, there's really no catches. It's all about the paycheck. Mm-hmm. So now this guy is an engineer. This guy is super smart, smarter than I am. And when I explained the chart, which he loves charts, when I explained the payout rate versus the roll-up rate, he was blown away. And there's a lot of lingo in our industry that is confusing to the consumer. And I'm not talking the average consumer. I'm talking about intelligent, smart people can be blown away by these numbers and can be fooled by them, okay? And you need someone like me who's independent, who knows how to read these things. But the bottom line for an income annuity is the paycheck, okay? And if it's a contract, Jess, and it's in writing, and it's backed by an A-rated company worth, $50-60 billion, which is a ton of them out there, there really is no fine print. There's your check. There's how it works. And there's even a death benefit there should you die early, that your heirs will still get some of the pile of that money. Now, the longer you live receiving that check, the less that pile becomes to the beneficiaries, because this is designed for the owner and or their spouse if they're married. So that's how that version works. And then there's another version that's a lot simpler. It's just an accumulation product. So think of it as like sort of like a CD works, where it's got safety of principal, all that good stuff. And it's basically fixed interest rates, and it works with what is called an S&P 500 cap. There are other fancier caps involved. I will not bore you with that on the radio. But the bottom line is an S&P 500, everybody knows what that is. They see it on TV. A lot of these products will use that to determine gain only, never a loss. So if the S&P's up, 10, you'll get 10. If it's up 12, you might get 10 because there's a cap on how much you can earn.
Gotcha.
But the other side of it is if the S&P is negative like it was in 22, like I say it's down 10, you keep not only what you started with, but anything you earned previous to that. How's that? Try doing that in the direct market. Try keeping what you made before. It doesn't happen. So these products are unbelievable once you understand how they work and what some of the limitations are on those versions, because most of them just give you 10% access. But some of these companies today, if you don't use that access, they'll give you 20% the next year and 30% the year after.
Get more details on the website, fairwayfinancial.net. That's fairwayfinancial.net.
Steve Anzoni is a licensed insurance provider by the Division of Insurance and is not registered as an investment advisor. Insurance and annuities offered through Steve Anzoni, Massachusetts Insurance License 3851053. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Read your contract for restrictions, limitations, or penalties. Steve Anzoni is not licensed in all 50 states. To find out if Steve Anzoni is licensed in your state, please call 508-398-3337.